Ladies and gentlemen, let's take a deep breath because Japan, once again, finds itself at a pivotal moment, both economically and politically. Shigeru Ishiba, the next potential Prime Minister of Japan, is stepping into this critical juncture. The implication, not just Japan, but the global economy, international relations, and the regional balance of power are about to face yet another era of uncertain continuity, masked by shiny promises of reform. But behind Ishiba's ascension hides a fragile foundation, a confluence of short-term fiscal maneuvering, stagnation, and complex geopolitical challenges that could push Japan deeper into an economic labyrinth it has long struggled to escape. Let's dig into what's really at play here. At first glance, Ishiba may appear to ride a wave of public optimism. According to a Mainichi newspaper survey, over 52% of the public felt optimistic about his administration. Why? Well, 3 reasons stand out. Ishiba's distance from previous administrations. He hasn't been tainted by the fundraising scandals that sunk outgoing Prime Minister Kishida's approval ratings. This distance gives him a clean image. Inflationary pressures. Japan's inflation problems have worsened public sentiment. Ishiba's promises to continue addressing economic uncertainties make him seem like a safer bet. Political vacuum. The opposition is in disarray, having just replaced its leader. The ruling Liberal Democratic Party, LDP, faces little risk of being replaced in the short term. What does this mean for investors? Well, the fact that Tokyo stock markets dropped by more than 3% on Monday morning, coinciding with Ishiba's leadership win, reveals growing concerns among Japanese and global investors. Why? Largely due to uncertainty surrounding the yen. More on that later. The shock reverberated strongly. Stakeholders in Japan are not buying the blissful optimism Ishiba's leadership victory might initially suggest. But let's cut to the chase. Ishiba represents continuity in economic management and monetary policy. Yet, continuity is precisely where the problem begins. You see, Japan's economic engine has sputtered for decades, surviving largely on makeshift arrangements, government intervention, fiscal tweaking, and a debt-to-GDP ratio climbing to a staggering 262%, the highest of any advanced nation. So, why would continuity or more of the same possibly lead to the revival Ishiba speaks of? And that's precisely where things get tricky. Let's face the critical issue. Japan's economy has been stuck in the mud ever since the lost decade of the 1990s. The central tools used to resolve these problems were Abenomics, a set of monetary, fiscal, and structural reforms brought about by former Prime Minister Shinzo Abe. However, these band-aid solutions are now coming undone. The once glorified monetary easing strategies, heavily supported by the Bank of Japan (BOJ), have reached an impasse. Under Katsunobu Kato as finance minister and Ishiba's leadership, we might expect some nominal continuity with occasional tweaks, but the real game-changing momentum is elusive. Kato's past stance, as quoted in a Bloomberg interview, is somewhat pragmatic, advocating for prices to keep moving and highlighting the structural distortions created by years of stagnation. These words signal a clear break from the ultra-accommodative policies of the last decades, although the shift will likely be more cautious. But let's not forget the severity of the underlying issue. Japan's public debt stands at over 1 quadrillion yen. Yes, you heard it right. That's quadrillion yen, amounting to roughly 262% of GDP as of this year. This mind-boggling debt load continues to raise red flags at the International Monetary Fund, IMF, and among international bondholders. Aging population. Japan's shrinking workforce and aging demographic are forcing the government to prop up pension costs and healthcare spending even as its taxable base shrinks. Estimates suggest that by 2040, there will be 1.5 workers per retiree, painting a grim picture for Japan's fiscal sustainability. Monetary easing has limits. The Bank of Japan has kept interest rates near or below zero for such a long time, distorting credit markets and suppressing household savings rates. Yes, this may have propped up housing and asset prices temporarily, but how long can this experiment sustain itself? In an era where inflationary pressures are becoming increasingly global due to supply chain constraints and geopolitical tensions, Japan's ultra-loose monetary policy may backfire. Ishiba, however, seems to be playing both sides of the fence. His support for policy normalization is a veiled indication that the BOJ might slowly roll back its ultra-loose stance. But caution rules the day. As he said in an interview to Fuji TV, We shouldn't be talking about interest rates when we still can't be sure deflation has been eradicated. On the other hand, the reality is that while deflation is no longer the immediate demon it once was, inflationary pressures are presenting new challenges. Japan is therefore caught in an economic crossfire. If it raises interest rates, it risks choking off already meager domestic demand and makes its debt load increasingly expensive to service. Conversely, by keeping rates too low, it risks runaway inflation, a weakening yen, and its people losing what little purchasing power they have left. The very real fear is that Japan is so deep in debt that monetarism is stretched to its limits, leaving little escape from continued stagnation. Speaking of inflation, let's not overlook the forex market's flashing red signals. Investors are anxious about the yen's future. Tokyo Stock's 3% drop isn't just about trade volumes. It's a reflection of shaky confidence in Japan's currency. In the last month, the yen has shown signs of strengthening after Sanai Takaichi, a major advocate of continued monetary easing, lost the Bank of Japan's leadership race to Kazuo Ueda. Foreign investors, until now betting on an indefinite yen devaluation under continued easing, quickly adjusted their portfolios. But will devaluation continue to be the only tool left in Japan's toolbox? To be fair, Japanese exports have benefited from a weak yen in recent years, giving companies like Toyota, Sony, and Panasonic competitiveness in the global marketplace. However, with inflation rearing its head, the Consumer Price Index, CPI, stands at its highest in 4 decades, an uncomfortable shift in a country long familiar with deflation. Worse still, domestic importers are feeling serious pain. Just this year, import costs for raw materials and energy soared as a weaker yen pushed up Japan's import bill, hitting family budgets hard. Quick economics 101 here, folks. A weaker currency makes imports costlier and diminishes consumer purchasing power. So, as the yen teeters on the edge of further devaluation or stabilization, Ishiba faces a core dilemma. What does he prioritize? Short-term export competitiveness at the cost of household incomes? Or a stronger yen to help families but at the risk of choking off industrial growth and investor sentiment? Now onto Japan's regional challenges, a situation that makes just focusing on the economy nearly impossible. Japan's foreign policy outlook entwines deeply with its economic health, especially when tensions with China, a crucial trading partner, continue souring. Consider this. Japan-Chinese relations are at a sharp low. Just earlier this month, the tragic stabbing of a Japanese schoolboy in China has triggered public outrage, worsening diplomatic ties. Japan's trade with China has been critical, comprising 20% of total trade, underscoring mutual dependence. Cooler heads must prevail, but Ishiba's government has so far struggled to articulate a coherent strategy for reconciling national security needs with economic interdependence with China, defense spending, and U.S. alliance. With regional tensions on the rise vis-a-vis North Korea's nuclear ambitions and China's assertiveness in the South China Sea, Japan's dependence on the U.S. for security is once again being questioned. Ishiba positions himself as a defense nerd, advocating for a more equal military partnership with America. But this can't come without costs. Japan's defense spending, which now exceeds the Cold War levels, siphons public resources that wouldn't otherwise be available for fiscal stimulus or renewing long-term economic commitments to sectors that urgently need reform. Think green energy. So what does this all lead to? Continuity, the very word Ishiba's leadership promises and the one Japan can least afford. A wait-and-see approach doesn't work when you're sitting on $12 trillion of public debt, a currency that's precariously inflated, and the challenges of an aging population that make long-term growth impossible without serious reform. However, Ishiba's pragmatic, if cautious, approach of slowing austerity while cautiously moving toward policy normalization might buy Japan some time, but only time. The real question is, how long can Japan keep juggling this economic tightrope? For professionals in finance, for all of you deeply engaged in market speculation, currency trades, or bond evaluations, the Ishiba administration may seem safe, but don't let the calm fool you. The iceberg of problems Japan faces runs much deeper than it appears. For ordinary savers, workers, and Japanese businesses, Ishiba's promise of continuity isn't really about maintaining balance. It's about walking a fine line between collapse and a stagnation that becomes more entrenched with each passing day. Let's break this down into concrete points. 1. The debt overhang. Japan's debt-to-GDP ratio has surpassed 260%, For context, that's not just the worst among major economies. It's closer to the ratio you might expect for an economy that has defaulted or faced hyperinflation in the past. But Japan isn't Argentina or Zimbabwe. As long as the BOJ remains the biggest holder of Japanese government bonds, about 45% of total JGBs, and there's international confidence in Japan's institutions to make good on its debts, an outright default isn't a real possibility. Yet, however, there's a significant debate bubbling beneath the surface. Will Japan ever be able to meaningfully reduce this debt? Or are we just kicking the can down the road until a much bigger crisis occurs? Most economists predict that Japan's current debt trajectory will be unsustainable within the next decade if serious, growth-oriented reforms don't take shape. Structural stagnation in productivity plus limited stimulus from inflation means the debt problem could spiral further out of control. So far, Ishiba has shown little evidence of taking radical steps to tackle long-term fiscal health beyond vague statements about responsibility and stimulation, the kind of language we've heard from every other prime minister since Junichiro Koizumi. And here's the elephant in the room. Bond markets are watching closely. For all the noise about Japan's internal debt load being manageable because of its BOJ bond buying program, the reality is that cracks in the shield are starting to form. Foreign debt holders, who still view Japan as a safe haven economy, are critical to propping up confidence. If this group begins to view Japan's debt as a weaker bet, particularly as inflation rises globally and interest rates in other advanced economies tick upwards, think the US Fed or the ECB, Japan could rapidly find itself in a serious bind. 2. The ticking demographic time bomb. It's no secret that Japan's demographic decline is its Achilles heel. The aging population is a debt anchor, constraining productivity, increasing healthcare costs, and shrinking the domestic consumer base. In 2023, nearly 30% of Japan's population was aged 65 or older, and it's predicted that by 2050, Japan's population will shrink by about 20 million people. A shrinking tax base in a country already facing giant fiscal debts adds even more anxiety to an already dire economic outlook. What's surprising is that Ishiba, despite vocally supporting policies to boost regional revitalization, has offered no concrete strategy to address the major factors behind these trends. Stalled birth rates, limited immigration, and inadequate family support policies. It's true that Japan's long-declining birth rate hit rock bottom, falling to about 1.3 children per woman, far below the 2.1 replacement rate. Proposed solutions, subsidies for young families, tax credits, and incentives to encourage childbirth, have been nothing short of band-aid treatments, barely moving the needle. Similarly, immigration could serve as a critical offsetting measure in bolstering Japan's shrinking workforce. However, Japan's strict immigration policies and a cultural aversion to large-scale inflows of foreign labor have left the country stymied. The question now becomes, will Ishiba be the one to loosen Japan's immigration doors? Historically, this has been politically radioactive territory in Japan, and there's been little indication Ishiba plans to push on such an initiative. When you contrast Japan's conservative demographic approach with countries like Germany or Canada, which are proactively using immigration to boost their economies and social safety nets, it becomes clear how reluctant Japan is to engage in significant change. Without addressing the demographic decline, no amount of monetary policy or economic leadership will save Japan from long-term stagnation. And here we are, returning once again to Japan's outdated monetary policies. The Bank of Japan, BOJ, has spent over 2 decades using aggressive monetary easing tools, negative interest rates, yield curve control, and an asset purchasing binge that has seen it absorb large percentages of the nation's equity and debt market. For many years, this created a sense of confidence despite Japan's perpetually low growth rates and inflation swings. But now we are reaching a point where these tools are losing their effectiveness. The prospect of policy normalization, or the BOJ finally beginning to taper off its extraordinary levels of support, has sent mixed messages to businesses and households wondering if this means higher borrowing costs or, simply, further instability. Economists around the world have compared Japan's situation to a nightmarish carnival ride where no one can get off the monetary easing train, even as signs of wear start to appear in the system. Negative interest rates. Japan's minus 0.1% short-term interest rate strategy was once seen as an escape from deflation but has led to record-low returns on savings and pension funds, forcing households and public institutions into even more risk-seeking investments. Yet this appears to be fading as a policy lever. Inflation in a deflationary world. Japan has long been associated with deflation risks, but the post-pandemic global inflation squeeze has added a new twist. Inflation hit an annual rate of 3.4% in 2023, and while this may seem minor compared to the inflationary nightmares faced by other advanced economies, it's deeply felt in Japan. Rising commodity prices, fuel, and food costs are hitting a population that has become accustomed to decades of price stagnation. What's truly alarming is that this inflationary pressure isn't driven by strong domestic demand, which would be ideal, but rather by the unstable global supply chain and the fallout from geopolitical tensions, such as the supply chain war with China and export restrictions. Let's be honest, the BOJ's solution to all economic ills for decades has been to grow the balance sheet and ensure continuous liquidity. But when real growth doesn't follow, that liquidity ends up feeding asset bubbles and makes investors far too comfortable with low-risk, low-return paradigms. Asset bubbles, fragile to external shocks, create systemic weaknesses in the country's long-term economic health. We might not have seen a Lehman-style collapse in Japan, but bubbles are dangerous precisely because we often don't know where they are until they pop. Continued monetary stimulus cannot mask the root causes of Japan's broader problems. Weak aggregate demand, structural inefficiencies, and a reliance on government stimulus to prop up sectors that need more innovation and market-driven competitiveness. Ishiba's leadership can talk about policy normalization all it wants, but at some point, the BOJ will run out of the magic it's conjured through aggressive easing. What makes Ishiba stand out within the LDP, Liberal Democratic Party, is his relative independence and clean slate compared to his predecessors' entanglements. The public seems hopeful for change, yet as we've discussed, the issues are so deeply entrenched that no single personality in office will be able to reverse them quickly. Furthermore, although the 52% public optimism cited in Mainichi surveys is encouraging for Ishiba's team, let's not forget the fickleness of political favor. As we've seen countless times in democracies globally, a temporary spike in approval doesn't guarantee sustained support through the economic trials of inflation, wage stagnation, and rising public anxiety around inequality and fiscal responsibility. If Ishiba's administration fails to deliver tangible results within the short window before the national election on October 27th, this optimism may collapse as quickly as it appeared. And here's the bind. Tapping into growth initiatives is difficult in a country where political power remains concentrated within a relatively conservative elite. Many of Japan's political veterans are constantly resistant to structural reforms that hurt their patronage networks. This inertia helps explain why there has been little dramatic change in Japan's policies since the lost decade of the 1990s, despite prime ministers coming, going, and promising sweeping reforms. A continuity-first approach, even if administered by a pragmatic leader like Ishiba, traps Japan into sticking with policies that have ensured that the country's economy only limps forward, never running, never collapsing, just underperforming indefinitely, or until a more extreme crisis forces the hand of change. We cannot ignore the elephant in the room: Japan's growing unease with China. The tragic killing of a Japanese schoolboy in southern China has only served to exacerbate national tensions. This episode comes at a time when Japanese businesses and trade, still heavily dependent on China, are watching closely whether diplomatic relations continue to sour. In 2023, trade between Japan and China represented over $340 billion, making China Japan's single largest trading partner. Any significant rupture in relations could massively impact Japanese exporters and further strain Japan's fragile economic recovery. Meanwhile, the geopolitical situation has become increasingly unstable, making Ishiba's calls for a more equal military partnership with the U.S. sound far more imperative. North Korea's missile launches and China's military activities in disputed territories not only require economic resources but sharp political decision-making. However, the problem is multifaceted. While antagonizing China is politically expedient to win nationalist support domestically, it is economically suicidal. Japanese businesses rely on Chinese trade for survival. How does Ishiba plan to balance these conflicting priorities?